I'm Laura Klum, Vice President of Philanthropy, and thank you so much for coming out on a rainy, stormy night and hearing us tonight. So we just want this to be an informal conversation. This is Brittany Lawson and Rob Lawson with Inspired Wealth Advisors, and they are here to tell us a little bit and then take questions really about tax-wise ways to make a difference with your favorite charities, but also protect yourselves from Uncle Sam. So I'm going to pass it over to you with that.
My favorite uncle.
That's right. So thanks so much for having us, guys. Yeah, go ahead, Rob.
Well, let's test the microphone first so everybody can hear me.
Good.
Awesome. Well, again, thanks for having us again. I'm so excited for you guys to be here. Rob and Brittany Lawson, we have the same last name. If you didn't figure it out, we're partners in business and partners in life. So she keeps me in check, actually everywhere. I don't get away from her. So again, hopefully everybody enjoyed the charcuterie and had a drink. If you had a drink, this is going to be a lot more fun. If you didn't, it'll be okay too. So really, our intention to be here tonight is to talk to you about planned giving and how you use planned giving to maximize the impact on the people you love and the causes you care about. When I think about giving, actually, let me back up. I want to, like I said, we want this to be a conversation. So we'd love for you guys to participate. If you have questions as we're talking, feel free to raise your hand, shout out a question. We don't care. We're good. We're not your third grade teacher, okay? So let's make it fun. We have a teacher in the room, so I wasn't directed at you, Charity. Sorry about that. But please feel free to engage as we talk. If I ask questions and you don't answer, I'll just stare at you until you do. So let's jump into this. So when we think about just giving in general, right? I know everybody in here gives to their favorite charities and their churches, but I really think about giving in three ways. The first is spontaneous. When I think about spontaneous giving, and I think, us and Kentuckians and Americans in general are great at this. A need comes up, maybe it's a flood in eastern Kentucky or a fire in California or a hurricane in Louisiana, right? We immediately dig into our pockets and we give to these charities and causes we care so much about, right? To help people in a moment of need, right? And I want to point out, how do we give most of those gifts? We reach into our pocketbook, right? That money mostly comes from our checking and savings account. The second way we give on a regular basis is intentional giving. When I say intentional giving, think about causes you care about throughout the year. It doesn't matter what the year is or what's actually happened. Maybe it's Bluegrass Care Navigators, maybe it's your church. But you give on a routine basis, whether it's weekly, annually, or monthly. But you give them gifts throughout the year because it's something that's important to you all the time, not just in a moment. But again, I want to point out, most of those gifts are given in cash. Right? And when I say cash, guys, I don't mean you're actually giving dollar bills. You could be writing a check or an ACH through your bank account. But the third way we give, and the reason we're here tonight, is talk about planned giving. Planned giving is quite different than the other two. It's very similar to intentional giving, that it's something that we're intentional about, of course. But the key difference is that we're not just giving cash anymore. We're giving other things. We're giving stock, bonds, we're giving real estate, we're giving away businesses. Right? We're using various different types of financial and legal instruments that allow us to maximize the impact we're making on the organization. And we're going to spend some time today talking through those types. Again, I should say this too. I don't expect anybody to walk away from here with a PhD in charitable giving, right? You don't need to be able to teach a class on it tomorrow, but I hope it inspires you a little bit to ask more questions of an expert. So when I think about planned giving, first thing I want to tell you, only about 36% of the American population even understands there is such a thing. There is a way, there are instruments out there to maximize our giving. And of that 36%, less than half of those participate in planned giving. Okay, so we have a big problem, right? Number one, awareness. Well, even the people who know about planned giving, why do you guys think people don't participate in planned gifts? They don't understand it, right? They think it's too complicated. I think that's a great point. Anything else that comes to mind? There are no wrong answers.
Too complex?
Too complex, yep.
They've never done it before.
They've never done it before. Anything else?
They want to take care of their family.
They want to take care of their family. That's a big one, right? They go, well, if I'm doing all this planned giving, I'm blessed to give to the kids, right? Which, by the way, guys, not true. We're going to talk about that tonight. Maybe you do give less to your family, but maybe you actually give more to the charity and your family. And we'll talk about a couple of strategies where maybe somebody could do that. Anything else? I think, Stephen, you had something.
I would say save it for later. Kick it down the road.
Kick the can down the road, right? We don't have time for it right now. Anything else come to mind for why somebody may not participate in a planned giving strategy?
They don't have anything, or they don't think they have.
They don't think they have enough. That's a big one, right? We all the time, they're, well, that's only for the wealthy. That's for the rich of the rich. Not true. It doesn't matter if you make $50,000, 500, or 5 million. You can participate in planned giving on some level. So that's not true either. Anything else? We cover them all? Any other misconceptions or perceptions? We had a conversation about this earlier. Inside joke here.
Misconception, not misperception.
Yeah, so yeah, we hit a lot of them there, guys. So there's a lot of reasons people choose not to. Hopefully after today's presentation, you guys are saying, maybe I can do this if I'm not already participating in planned giving. So why should you do planned giving? What's the benefit? Actually, this one's super simple, guys. There's really two main reasons. Number one, you get to give away more money to the causes you care about, right? To the people you love and the causes you care about, a lot more money is going to go to them. Secondly, we get to give taxes. You get to give less money to your favorite Uncle Sam, right? So you give less to Uncle Sam, you give more to the people you love and the causes you care about. That's why you should be doing planned giving. That's why you should be talking to a professional in planned giving, be a financial advisor who specializes in that, or some type of estate attorney who specializes in charitable giving. So let's jump into it. When we think about planned giving, I really break it into three categories. I think about giving now, so that's dollars we're giving today to help an organization. Two would be giving and receiving. That means we're giving away today, but we're also maybe receiving something in return. And thirdly would be just to give later, right? The estate gifts. And I'm going to tell you, and I think the guys at Bluegrass Care Navigators would tell you this as well. The give now gifts are exceptionally important, right? It's a lifeblood of the organization. But so are the give later gifts, right? The estate gifts. Sometimes people, they can't choose which one they want to do, but those give later gifts often help create endowments and help the organizations plan, not just for this year, but for 5 years, 10 years, 50, and 100 years down the road. So both of those are very important, but whatever's most important to you is the way you should be doing it. So let's jump into some, go.
No.
Okay. Oh, sorry, yeah. So let's jump into the give now gifts. I'm going to kick us off with gifts of stock. To me, this is the most simple way that anybody should participate in planned giving. So gifts of stock. Let's say that 3 or 4 years ago, you bought $10,000 worth of NVIDIA, right? Everybody heard of NVIDIA? Right, it's a stock company. They do something in technology, right? So 3 or 4 years ago, you bought $10,000 worth. That stock's worth $40,000 now, okay? You're also really charitable, and you want to give $40,000 to the Bluegrass Care Navigators. Now, what you might have done, if you hadn't thought about giving the stock itself, you might say, well, I'm going to sell that stock. And $40,000 minus $10,000, which is what you bought it for, is $30,000. So you guys keep tracking with me here. You're going to pay taxes on $30,000 when you sell that stock. Now, the average person is in the 15% long-term capital gains rate, right? Some of you guys are in the 20% long-term capital gains. But let's just say 15, because that's normal, that's average. That means you're going to pay $4,500 on taxes on that gift. You're going to take it out, put it in cash, pay $4,500 in taxes. You're going to have just over $35,000 left to give Bluegrass Care Navigators. We're going to say, why are we doing that? Let's instead give the stock directly to Bluegrass Care Navigators. Do you guys have a stock receiving account? Of course you do, right? Because you're a good organization. So they have a stock receiving account. What you're going to do is call up your broker and you say, send that $40,000 in NVIDIA stock right over to Bluegrass Care Navigators. They're going to receive it, and guess what? When they sell that stock, you guys have to pay taxes on it? You don't have to pay taxes on it, right? So we avoid that $4,500 of tax Uncle Sam's trying to collect by sending that stock directly to the organization you care about. Now, let's say your organization you care about is somebody other than Bluegrass Care Navigators. They don't have a stock receiving account. There's also a way to do that, and we're going to talk about that in just a second. Any questions on gifts of stock? Yes, sir.
If I want to give a lump sum.
Yep.
Is there a limit on how long I have to live to keep that from going back into my estate?
No. You're saying if you give it to the charity? If you give that lump sum to the charity?
If I give it to my heirs.
Mm-hmm.
To your heirs is a different conversation.
Yeah, it's a different conversation.
You have one?
Yeah, that would, if you're giving it to a charity, then it's the charity owns it. But if you're saying you're giving it to your heirs, that's a little different conversation, so.
There is a time limit in there.
Sure.
That I've got to live so long after that gift.
Yep,
I can't give the gift on my deathbed, or it will go back into the estate.
correct. If you're talking about gifts to family members, right? Not to a charity. Yeah, so that's true if you're giving it to somebody other than a charity. But if we're giving it to a charity, it's out of your estate. You've given it away. Yep. So the last thing I want to mention about gifts to stock, every once in a while I get the guy who says, you know what, I don't think I'm just going to get $40,000 in cash. I love this NVIDIA stock. It's going to keep growing. I'm going to tell him, you're not wrong. It is going to probably keep growing. But let's do this instead. Let's give that $40,000 to that charity, and let's take the $40,000 in cash you had, and let's repurchase it. And you just wiped out all the gains, right? Now you got $40,000 cost basis with no gain. That's a beautiful thing, right? So keep investing. And sometimes I hear that, so I want to take that off the plate. So Brittany, you want to tell us a little bit about donor advised funds?
Okay, any questions so far? Okay, so one of the questions, or one of the things that Rob mentioned, was some people, or some institutions, not people, some institutions might not have a stock receiving account. So they may not be able to accept those gifts of appreciated securities. Has anybody in here ever heard of a donor advised fund, or
Yeah.
my A+ clients over here? So I'm gonna give you some language about how we talk about donor advised funds, and then I'm gonna talk to you a little bit about what they actually are and what they aren't. So I want you to affectionately think about a donor advised fund as your own personal charitable checking account. So money can go in, but it's irrevocably assigned for charitable giving, okay? So some folks might choose to gift cash, appreciated securities, as Rob said, business interests, real estate, a lot of different types of things can go to fund a donor advised fund. And then that donor advised fund winds up being a holding account for assets that are earmarked for charity, but can be distributed in part or in whole immediately, later, or upon death. So in our world, we sometimes talk about it as, again, that charitable checking account, and other times we use it kind of like a charitable estate or a charitable trust for our donors after death, okay? So functionally, the way that a donor advised fund works is you would work directly with a foundation, foundations like National Christian Foundation, Bluegrass Community Foundation, Thrivent Charitable, those are all foundations. And you would establish your donor advised fund. That donor advised fund, you can put gifts of cash, equities, or complex assets, again, like real estate or business interests, and you get a tax deduction in the year that you put the money in. Has anybody heard of charitable stacking or charitable bunching or charitable clumping? So this is a way, like, as an example, if we're working with clients that have an intention to give regularly. So they have good intentional giving. Maybe they give $12,000 or $15,000 or $20,000 a year to a combination of churches and charities. Maybe they have a little bit of property taxes and some state income taxes that they pay. But the combination of what they're giving and what they would itemize on their tax return doesn't exceed the standard deduction on their federal tax form, right? So back in 2017, the Tax Cuts and Jobs Act increased the standard deduction to almost, right now it's $32,000 for a married couple. So a lot of people are giving, but they're not receiving a tax deduction or a tax benefit for that gift. So oftentimes we will encourage our clients to stack their charitable giving. So if you're going to give $10,000 or $12,000 or $15,000 this year, and you're going to do the same exact thing next year, what if we were to accelerate that gift into the same tax year so that you maybe get over that standard deduction and you get a tax benefit for the gift that you're giving? Stop for just a second and breathe. It's a way to maximize tax deductions for the gifts that you're giving anyway. The donor advised fund winds up being a tool that allows you to stretch those deductions or to stretch those distributions into future tax years. So you get the deduction in one tax year, but you stretch the distribution in future years. That make sense? And it might not be 1 year, it might be 2 or 3 or 4 years. Because maybe in this example that Rob was talking about, we have $40,000 of NVIDIA that a client wants to get rid of or capitalize on the gains. They put it into their donor advised fund, and maybe they distribute $10,000 per year for the next 4 years towards some capital campaign that they committed to with Bluegrass Community Foundation or their other favorite charities and churches. Make sense? All right, so donor advised fund is a way to maximize giving. It's also a tool that clients use when an institution can't accept those outright gifts or those complex gifts. It's a way of creating that account that receives those more complex assets when the institution can't, and then you distribute it from there.
Mm-hmm. Yeah, a couple things I'll add. Brittany used the term charitable checking account, and that's what we call it. We have one ourselves. So a lot of you guys probably give to more organizations than just Bluegrass Community Foundation, I'm guessing. This looks like a really generous group. So, you know, you may give to 10 different organizations, which means what? You have to keep up with 10 different receipts where you gave that money to. That's one of the other, it's a small advantage, but it's something I think is important. So when we give to 10 different organizations, I only have to keep up with one receipt. It's the money I put in my donor advised fund.
Is that through your brokerage account?
Well, it has to be through a foundation. So a lot of brokerages have created them recently. The ones that are most commonly used, we use Thrivent Charitable for obvious reasons because we're connected to Thrivent. But National Christian Foundation has one. Bluegrass Community Foundation has them as well. And then there's also Fidelity has actually created one recently. Schwab has created one recently. Vanguard, I think, actually has one. So it's become more of a popular thing in the last few years where a lot of the bigger brokerage and wirehouses have started creating them.
So when you contribute, say, to a charitable fund or charitable
Donor advised fund.
entity, and it comes from a brokerage company, depending on how they handle it, they handle it the right way, you get credit for the contribution, plus you don't pay taxes on it.
Right. Well, in this case,
Right?
That is correct.
yep, that's correct. Yeah.
You're talking about rollover from an IRA or IRA contribution.
Yeah, we'll get to QCDs in just a second. That's a different conversation. So we're gonna get to that one in a minute. But back to the donor advised fund. So you're getting, to Brittany's point, I'm gonna use bigger numbers because I think it's easier to even help to really make for it all come together. Let's say you're somebody who gives $20,000 a year away, right, each year. Right, it's just it's like clockwork. It's just what you do, right? So, but you also have the cash in the bank right now to give away for 5 or 6 years, maybe more. Maybe your brokerage account, right, at Schwab or Fidelity or at Thrivent, you have a lot of appreciated stock. We might tell you to put $100,000 today into the donor advised fund. You get a $100,000 tax deduction today. Okay, you're not going to give all $100,000 to your favorite charity just yet, but you're getting a tax deduction day one. Then each year for the next 5 years, out of that donor advised fund, you're going to give $20,000, just like you would have.
But you don't get to count it twice.
You don't get to count it twice, but you wasn't getting much credit for it to start with because you were only, in this scenario,
You got to get above
the standard deduction of
You get bang for
$32,000.
your buck. Okay.
Exactly. This way, by using the $100,000 up front, you're getting an additional $70,000 of tax deductions that you would not have otherwise gotten.
this year.
Over the course of 5 years, but particularly in the 1 year, yeah. So donor advised funds are great tools to use. They help, to me, they help with the bookkeeping, the tracking becomes much easier. It allows you to stack charitable gifts, which is what we're currently talking about. So they're great instruments to use.
But so with that, it's the donor advised fund. You said it's through the foundation.
Mhm.
But you can have one fund that you give to different foundations, or?
Correct.
Yeah.
Yeah. So, yeah, but you can create it, again, so as an example, Thrivent as an organization, that's our organization. We may have your investments or your money for managing it, but then Thrivent Charitable, right? Or maybe it's Fidelity Charitable or Schwab Charitable has a separate entity under the umbrella. So, and they're actually the nonprofit arm, right? And that's who holds the donor advised fund.
Here's your catch. Once you put it in, it can only go back out to your charitable intent.
Mm-hmm.
So we only want to put as much money into that as you feel comfortable is what you're earmarking for charitable giving, right?
But
But you can change who you want to give it to as long as it's a charity.
Yes,
All the time, yeah.
yeah, and so yes, you can choose not to distribute any money from the donor advised fund. And once it's inside of that account, you're going to be able to continue investing it. Now, this is a caveat, okay? If you're transferring NVIDIA, the foundation is not in the business of keeping NVIDIA stock. So they don't want to keep a concentrated position. They will sell it. The foundation doesn't pay any taxes because it's a nonprofit entity. And then the cash raised from the sale of that NVIDIA stock now can be invested in a money market account or a balanced fund or an S&P index fund. It will invest in a broader scope of things. Because it's a nonprofit, just like you're a nonprofit, just like Bluegrass Community, yes, I'm looking at you, but you're all the same. Bluegrass Community Foundation is a nonprofit. They don't pay taxes. As the donor advised fund grows, you do not pay taxes on that growth, which just means that you have more tax-free benefits going out later.
You've been mentioning Bluegrass Community Foundation. With that,
Oh.
can you donate?
Oh, listen, I just keep yes.
Which charity you want to go through, but you've been meaning to say.
I
Bluegrass
have.
Care and Advocacy.
I have, yes, 100%. I had a glass of wine, I shouldn't have.
Just having too much fun, yeah.
Bluegrass Care, you guys could have stopped. You should have stopped. But that's right, Bluegrass Care Navigators.
To me, and my wife and I, we kind of handle things differently, but it's, you're giving money away that you would be taking out 30, 40 years from now. You know, you got a portfolio, and your walk around money, your disposable income, you still get to keep more of it because it's coming from a different source.
Yep.
And you know, it's like I say, that's probably giving your kids inheritance away. That's really what you're doing. Does that make sense?
So we'll talk a little bit about that too towards the end, is that there's a way to do planned and intentional giving that doesn't necessarily take money away from well, you are giving it away, but it doesn't necessarily have to take money away from your estate. It doesn't have to take money away from the people that you love. There's a way to magnify both, to be able to continue to give to the people that you love, but also increase what you get to do with the causes that you care about.
Yeah, and I'm gonna make one more comment on donor advised funds. Because what we said a minute ago, once that money goes in, it's in. Like, it's only meant for charitable use. Again, you can change which charities you give it to at any time. And if you're thinking,
lower the value of your portfolio.
well, you're moving money from your portfolio, from pocket A to pocket B.
Once it goes into a charity, your portfolio goes down.
Your net worth,
You
your
got it.
personal net worth goes down.
Yes, exactly.
So let's talk through that though. Let's say that is 100% true, right? Now, let's say you moved 100,000 into the donor advised fund. Yes, your portfolio over here just went down by 100,000. But now that 20,000 you normally gave away each year is going back into your portfolio and rebuilding it. Right? So your portfolio is going back to growing again. Right? And again, remember, this only works if you are a consistent, generous giver.
Your portfolio goes down incrementally over so much this year, so much next year, so much in the fall.
Sure.
Right.
Yeah. So the last thing I will say about donor advised funds. So you might also be thinking, well, what if I die? Right? When you die. Yeah, well, what if you die with a lot of money? Let's say you put 100,000 to a donor advised fund and you die the next day, right? So we have a lot of clients, and you get to choose a lot of options here. The money just doesn't just go away. You might say it's an organization. I know Bluegrass Care Navigators needs X amount from me every year. So you might build into that donor advised fund. Upon my passing, I want in perpetuity for 5% to go from that portfolio every year. Bluegrass Care Navigators is going to remember me, as long as they're an organization, because they're going to get a check 20 years after I'm dead, right? It's going to keep coming, 5% a year. You might also say, we have actually several clients who do this, who they want to continue to teach generosity to their kids, to their grandkids. So they've created the fund to where their grandkids or their children are now the advisor successors. So they get to come in and their kids get to give away money that they had left, right? And it's a way for them to pass on their generous spirit to their own children or grandchildren. Yes, sir.
How does this affect, I'm looking at it from the opposite, how does it affect the receiving institution? Let's say Bluegrass Care Navigators. They would enjoy, from any of us who give regularly to that, a regular each year contribution. Now, if we do the stacking thing, have we introduced a irregular receipt to the receiving institution, which they would have to do.
Not if you don't want to. So the answer would be that it should look exactly the same to Bluegrass Care Navigators as it previously did. It should look exactly the same. Here's what I think Brittany would agree with me. Would you agree that people who open donor advised funds actually become more generous?
Yes.
It's an amazing thing to me. The people, our client, we've done this for quite a while now, right? We've actually seen people give more money away than they've ever given when that money's now in a donor advised fund. I'm not saying you would or you have to because you don't, but there's something about it. Once it goes in there, it's so much easier to give away. But to answer your question, to be very clear, it affects the receiving organization in no way. They don't see the difference. They'll get a check, instead of the check coming from your checking account, if it's Thrivent Charitable that's sending it, it'll say Thrivent Charitable, and it'll have your name, who the donor was.
Well, if you have a donor advised fund, as far as the growth potential of it, you decide how that fund is invested while it's in there before you.
You do.
Yeah, you do. So you get options. You get a lot of different investment options. So everybody's a little different. So whether you're using Thrivent Charitable, Fidelity Charitable, National Christian Foundation, or whatever charitable organization you choose to open the donor advised fund with, most of them have somewhere between 6 and 10 kind of, I would say, generic asset allocation type of portfolios would be on average, right? If it's a certain amount of money you put in there, your advisor might continue to manage that money. So we have a lot of clients, we continue to manage their donor advised fund for them.
But so are you saying, though, you have to have a donor advised fund for each organization
No.
that you're donating?
Nope,
No.
nope.
We
One-
have
I confused you.
one,
No.
And you set up who you want to send, it sends the money automatically. You set it up, you want this
Yep.
much to go to this organization every month. You just set it up and it.
So I could
goes
donate
without
to
doing
Bluegrass
anything
Care
with it.
Navigators and Bluegrass Community.
You could.
Foundation.
You could.
On the same donor advised fund.
Yeah.
Yep.
I confused everybody.
Yeah.
Forget Bluegrass
Yeah.
Community Foundation. Remember Bluegrass Care
So-
Navigators.
Yeah.
They would have to have, what kind of an account did they have?
They would not have to have any fund. Okay, so taking a high step back. Look at a foundation. Think about a donor advised fund. A donor advised fund is just your charitable checking account. You're going to decide, I'm going to put cash, securities, or something else entirely, a collection of coins that the foundation is going to sell. You're going to put something into this charitable checking account, and then it's there. It is at a nonprofit institution, names of which I will give you later if we want to restate it, but I'm not going to say it again. Right now, it's a charitable checking account, your donor advised fund. Then that money, when it's in there, you can choose any combination of churches, charities, educational institutions, nonprofits. You can choose to send some of it, all of it, none of it, at whatever interval you choose. When it gets to 0, you have no money in your charitable checking account. That check will bounce and you either have to refill it because you loved it and you want to do it again, or you decide that you're going to persist in, not having a donor advised fund going
One
forward.
more question.
Yep.
Can RMDs be put into it?
Required minimum distributions.
Oh, we're about to get there. We're about to get there.
Yeah. So actually, that is. So the next one is, there is a certain point at which there are other assets that are most efficient to go to church or charity. And when you turn 70 and a half, that's a magical
73
age.
now.
Oh, 70 and a half.
70 and a half.
7 and a half.
Oh, okay, got it.
Yeah. So there's required minimum distribution ages, and if you want me to go through the tax code with you, I'm not a tax advisor, I'm not a tax accountant, I'm not an attorney, but I know a lot about all of those things. So like I can talk to you about RMDs, required beginning ages, but 70 and a half is the magical age for something called qualified charitable distributions. So one rule that you need to know walking out of here is if you are near 70 and a half or older than 70 and a half, and you're not giving from your IRAs, if you have old 401ks, pre-tax accounts, I'm telling you it has to be an IRA, an individual retirement account. So if you're not giving from an IRA, you are paying too much in taxes. That is a promise, okay?
100%.
So there is a point at which we have to, there's a golden window. 59 and a half is when you gain unlimited access. Now you're getting a retirement planning speech here, but 59 and a half is when we gain penalty-free access to our retirement accounts. It used to be that at 70 and a half, we had to start taking required minimum distributions from those accounts. Now, I could go back in time. 2019 was a Secure Act. 2023 was a Secure Act 2.0. But basically, those two things made the required minimum distribution age 72, then 73, then 74, then 75. So depending on when you were born and when you turned required beginning age in the last 5 years will determine whether your RMD started at 70.5 or if they're going to start at 75. So as I survey the group, there's some of us that will not have RMDs until we're 75, and there's some of us that had them at 70.5, okay?
It varies based on how old you are now.
It is, yeah. So if you were born after 1960, your required minimum distribution age is 75. If 1960, if you were born after 1960, it's 75. If you were born before 1960 and you were not yet 73 in 2024, then 73 is your required beginning age. And if you're born in 1959, it's either 74 or 75.
Tell us about those QCDs.
All right, ready?
Yeah,
Here we go. So qualified charitable distributions. Qualified charitable distributions, right? This is a way for you to give away your pre-tax money that was going to be taxable to you, right? Like the IRAs and the 401ks that most of us have saved into, we put the money in on a pre-tax basis. We got the tax deduction when we put it in. That money, plus anything that our company put in, plus all of the growth that we've experienced inside of those portfolios over time, eventually we have to start taking it out. That's what that required minimum distribution is, okay? So whether it's 70.5, 73, 74, 75, you're gonna have to start taking money out. And what we have found time and again with our clients, and you guys might find yourselves in a similar situation, you might have oversaved. And if you oversaved, nothing is more aggravating than getting this love letter from the IRS that says you have to take the money and you get to pay taxes on it. Oh, and when you do, you might have to pay more in Medicare taxes. We call that IRMA, I-R-M-A-A, Income-Related Monthly Adjustment Amounts for Medicare. Aunt Irma is related to Uncle Sam. We don't like either one of those. Just kidding. We want to pay taxes where taxes are due, but not a penny more and not a penny less because that's illegal. So we want to legally and ethically reduce the amount of taxes that we pay. So IRMA, Medicare premiums, and oftentimes it causes more of our Social Security to be taxed. And if we've also built up a large non-qualified, so non-retirement portfolio, it causes more and more of our capital gains to be taxed at higher tax rates. So distributions from retirement accounts later stage that we don't need winds up being a very tax inefficient strategy. So qualified charitable distributions, beginning as early as age 70.5, even if your RMD age is later, means that you get to give that pre-tax IRA money away to church or charity irrevocably. So it's just like if you were going to write a $20,000 check out of your bank account, give it from your IRA instead. You skip all of the taxation, so it does not even report at all to your tax return. The charity or church receives it completely tax-free. So you don't pay taxes, they don't pay taxes. IRMA does not come into the calculation at all. And you've satisfied your charitable intent. So we have started giving from our assets instead of from our cash flow, which makes your portfolio more efficient.
Does it still count as a charitable contribution on your tax return?
Well, no. So if you're going to do a qualified charitable distribution, that's line 17 on your tax form. It's an above the line deduction. So if you take it off of the top, you don't get to also take it off of the Schedule A. So you just don't count it as income, but you do not get to write it off on your itemized tax return.
Yeah, I'll share a quick example how that might look. So let's say that you normally have $80,000 of income, pension, Social Security, whatever. Don't really care where it comes from. You have $80,000 of income, but then you take, and that's $80,000 you need to live on. Each year, you've been taking $20,000 from your IRA. Maybe it's required, maybe it's not. Nonetheless, you take it from there. That $20,000 you turn around and give away. So now your income's 100 on the tax return, right? You have 80. You take an additional 20 that you're just going to give away. Top of the line is now 100,000, right? The 20,000 is less than the standard deduction of 32,000. So 32 minus 100 is 68,000. So which means I pay taxes on 68,000. Now let's say that I use a qualified charitable distribution instead. My income's 80,000. Instead of taking the 20,000 first, I'm going to give it directly to Bluegrass Care Navigators. Okay? My income on my tax return is still 80,000 on the top of the line. I still get to take the full standard deduction of 32,000, which is 48,000. So now your taxable income is only 48,000 by using a QCD, where it would have been 68,000 if you had not used the QCD. So at the end of the day, if you are 70 and a half, close to it, if you know somebody at 70 and a half and they're giving $1 away and not using a QCD and they have an IRA, fix it.
You have to set up an account in your brokerage fund, brokerage account that's strictly for charitable contributions in order to avoid the.
Not for this.
Not
So
for
the
qualified charitable
So
distribution.
this is where I think we might be crossing a lot. We're talking about a lot of things here. But with the IRA, this comes directly from your IRA. Now, we'll tell you, depending on who your financial institution is or who you use, the ease of doing this varies greatly. I know with us, it's super easy. We do it, click a button, boom. Some financial organizations make it a little tougher on you, make you sign a bunch of forms every time. The ease of it does change based on who you invest your money with.
But it's still worthwhile, even if it's a
Even
pain in the tail.
Yeah, even if it's a pain, you should do it. And then to Brittany's point on the Medicare and IRMA doesn't care what you actually pay taxes on. She only cares what the top of your tax return says. The top line, before all.
It's not your AGI then.
It
No.
is. It's your AGI. So
Yep.
actually they care about MAGI.
MAG, modified adjusted gross income. So it's the very top of the line. And back to the Medicare, so IRMA determines how much your Medicare premium is. Now, once you turn 65, at base you pay what, $202? Is it 202? $202. Now, if your top of the line goes over by 1 penny, your Medicare premium might go from 200 to 400 to 600 to 700 per month. Now, the government doesn't like to call that a tax. But I think we all can agree that's a tax, right? So it can, so again, and that may be because of money you don't want or need. Money you're just turning around giving away anyway. The government doesn't care. You went over by 1 penny, they're going to charge you more.
So does that has to be an IRA, give 457, something like that?
It has to be an IRA.
Has
I
to
gotta
be.
roll that over.
Mhm.
So there's several reasons we would tell you to move money out of a 457 or 401k into an IRA, but this is absolutely one of them. If you're 70 and a half, this is actually reason number one every time.
So then one of your questions, yep.
You use a QCD to put money in your donor advised fund?
I was gonna answer
Get in
that.
there.
Not to a donor advised fund, but you can put it into a non-advised donor fund, which basically just means you've selected an irrevocable set of organizations to receive that money over a specified period of time. So you cannot change. So if I do a non-advised donor fund and I want to put $50,000 of a QCD into that fund, that is now irrevocably assigned to whatever nonprofit institution or church I selected. And then it sends out a defined dollar amount over time.
And can that be multiple?
It can be.
Sure.
Yeah, and so we've seen people do like multiple non-advised donor funds with QCDs. Something that's even more interesting sometimes is to do like a charitable life insurance policy, which we'll talk about next. Yeah, Laura.
Why is an IRA a bad thing to leave to your children?
Ooh, that's a good question.
What was the question again?
Why is an IRA a bad asset to leave to your children? It's not necessarily a bad asset. It just means that you're passing the tax buck on to the next generation. So when we have accumulated retirement accounts on a pre-tax basis, we have to pay taxes on it when we take the distribution unless we give it away. Most of the people that we're working with die after their age 70 and a half, right? So you're already starting to take your required distribution. When your children, so somebody younger, like 10 years younger than you, that's the rule. So not your spouse, but somebody 10, even if it is your spouse that's 10 years younger, they get a different rule, but like your children. So next generation inherits an IRA. The same Secure Act that told us that the RMD age went from 70 and a half to 73 to 75 also did something called Killed the Stretch IRA. So before 2019, beneficiaries used to be able to take a required minimum distribution for the rest of their natural lifetimes. So if I inherited $100,000 from my parents in my 40s, I would have until I die to take minimum distributions from that account. Post 2019, so this January 1, 2020, going forward, any individual who inherits a second generation IRA has to take it out in 10 years. So it's easy to stretch taxes potentially, to time it potentially, stretching it out over your lifetime. But now when you have to take 100% of that IRA distribution in 10 years, oh, and by the way, if the person who died had already taken RMDs, you also have to take an annual required minimum distribution. You have less control over how much taxes or how much the IRS owns of your estate strategy. So it's less desirable for your kids to inherit a traditional IRA or a 457 or a 401k or a TSP. It's more desirable for them to inherit Roth IRAs, cash value life insurance, and non-qualified assets, including your house. So that's why we oftentimes say that traditional IRAs and pre-tax retirement accounts are the perfect legacy gift to nonprofit institutions.
If you, there's a cost to converting to a Roth, right?
There is.
Mm-hmm.
And that cost would be negative in its effect on your heirs. So if you do the math, why is it that going to a Roth, for example, is better than just leaving it alone? You're going to pay it one way or the other.
I think a really important point on that, it depends, right? So the answer is it may not be the right decision. The answer it may absolutely be the right decision. That's why you need to work with a financial planner who can actually understands how to do the math on this to determine if it's the right decision for you. So yeah, this is never a one-size-fits-all answer. So we're always going to be very clear on that. This is why it's important to work with a professional who this is what they actually do.
You're betting that the growth from your Wall Street is going to be more than what you're paying tax rate.
Well, it's two parts, right? So we don't want to go too far down this path, but just real quick, just what's the general reason you'd convert to a Roth? One, you're paying taxes at a known tax rate, right? So regardless, I don't know what everybody's tax rate is in here, but let's just say average is 22%. Anybody know what the national debt currently is? Exactly, right? Because you know why? Because it's went up $1 billion since we've been sitting in this room. None of us know because it's constantly moving. And national debt, how do you think we get that lower? There's only two ways to do it. To spend less, our government's terrible at that. Second way is to increase revenue, right? How do you increase revenue?
Raise taxes.
You raise taxes, right? So I would argue, can't guarantee this, I would argue you will never see a lower tax environment than what we're seeing today, right? So the other argument, yes, maybe the growth outpaces the taxes you paid, but it might also means you paid at a lower known tax rate, 22 instead of 32, 10 years from now. So there's a lot of things you can take into account, but every situation is different. Mm-hmm. We have clients, we tell all day to do Roth conversions. We have clients, we say it's not right for you. So
how do you do Roth convert? Because you've got an income cap for putting money into a Roth, correct?
No. If for a regular contribution, that's true in your working years, but to do a conversion, you can convert as many dollars as you want.
You're limited only by your willingness to pay taxes on the conversion.
Sure.
Which could be highly limiting.
Mm-hmm.
A lot of times we talk to people when we're doing charitable stacking or when we're doing a large planned gift to an institution like Bluegrass Care Navigators. We oftentimes bunch those charitable deductions. Instead of taking a tax break, we'll use that to either realize capital gains by trading the non-qualified portfolio, selling an appreciated asset like a real estate portfolio, or doing a significant Roth conversion. So we never want to let a charitable deduction go to waste. And we oftentimes pair those kind of strategies together. Yeah. We're getting good. What other kind of questions do we have in here so far?
On the qualified required distribution, if you're not required to do it until age 73, and you want to start at 70 and a half, can you quit?
Yeah.
And then start back?
You can. So the qualified charitable distribution is not a one-way street, but it's an irrevocable decision anytime you do the gift. So if you do a QCD one time, that gift is gone and you don't get to get it back. But if you decide next year you don't want to do that gift again, you don't have to. You could take the RMD, pay taxes on it, and spend it whatever way you want it to. Yeah, but for a lot of people that we work with, we're setting up these ongoing qualified charitable distributions to support the organizations that are dependent on their ongoing giving.
My real question was, can you start and then stop?
Yes,
Yes,
yes.
absolutely.
Yeah.
All right. Brittany, you want to tell us maybe about something you even worked on earlier today?
Today, this was a fun one. So we have a client who, 5 minutes. He gave me a time limit. We have a woman who is 82 years old. We've been working with her for a few years. She was recently widowed, like 2 years ago widowed, so she's a single filer. That's a whole nother conversation in itself. But now her tax brackets are condensed and she pays a lot higher taxes for the same level of income that she's grown accustomed to getting. Her fixed income between Social Securities and pensions is enough to meet her standard of living, and she has about $800,000 in a traditional IRA. We have historically been taking these required minimum distributions and directing it to her nonprofit interests, but her RMD this year is $40,000. She could only come up with $24,000 of gifts that she really felt she wanted to continue doing on an ongoing basis, but she doesn't want to take the other $16,000 as taxable income, so she's planning to give that away, and she's just throwing a dart at a board at which organization gets some of it. So she's got some.
Bluegrass care now.
We did. We absolutely did.
It might have came up, yeah.
Yeah. But they've got $12,000 going to the church. She's got $12,000 going to. They actually live in South Carolina, but she's got $12,000 going to a community foundation that provides elderly care inside of her Lutheran community. So she's got $12,000 going there. So it's $24,000. She's like, I guess I'll give $1,500 to South Carolina Educational TV. Maybe I'll give $1,000 to my grandchild's school fund to build a something at the school. But she's like, she's grasping. So I said, like, what if when you're gone, these organizations that have been dependent on $12,000 a year from you, $12,000 a year, what happens to those organizations when that $12,000 a year stops? She's like, well, I'd really like to keep giving them $12,000 a year. I said, well, they'd really like to continue receiving $12,000 a year. So I said, what if we took half of that required minimum distribution? You still give your 12 and 12, and actually we wound up doing a $48,000, but anyway, it doesn't matter. RMDs go up over time. But I said, what if we take $24,000, give that away annually, and then you take $24,000 and you buy a life insurance policy, a charitable life insurance policy, that day one, she's 82, day one endows $250,000 in a lump sum to provide for that ongoing charitable gift for an additional 10 to 15 years when you die. So we're taking $24,000, giving it away today. We're taking another $24,000 as a qualified charitable distribution, by the way, to fund a charitable life insurance policy owned by a charitable foundation and creating a pool, an additional estate, something that didn't exist before, $250,000 that's going to support the ongoing needs of those organizations when you're gone. And she was like, oh my God. Anyway, it was a teary meeting, joyful meeting. The catch is she has to qualify for insurance. So, but we've just made a way to provide for a tax-free estate.
But then would that be $24,000 a year?
Mm-hmm.
Yeah. So I figured she
Can you do that for a trust,
What kind of a trust? What do you mean?
like a special needs trust?
You can?
Mm-hmm.
You can't use a charitable life insurance policy to fund a special needs trust. But, but life insurance is a very efficient way of funding special needs or supplemental needs trusts. So that's kind of a fun little thing that we're working on.
Yeah, and again, this is money that she's receiving, she doesn't even want, right? And this is a way we took it off her tax. Now we put it into something that she does want, right? Which is an ongoing gift after she passes, and she doesn't have to pay taxes on it today. So it's a win-win-win all the way around. So pretty cool. All right. So I know we're getting close on time. We got a few other things we want to run through. I know we're hitting you guys with a lot of strategies today. But the reason we're hitting you with so many, we could have spent, honestly, we could have, matter of fact, we spoke here for a full hour just on QCDs, right? So and we could do a full hour in anything we're talking. Probably could spend 2 hours on any of these things, right? But we want to hit you guys with a lot of different potential strategies, not so you can walk out here and go, I know how to implement that now, to let you know there's a lot of things that exist to help you give more and maximize the impact you're making. So a few others I want to hit on quickly. One of those things I said earlier, sometimes we get to give and receive. So one of the primary ways people do that is something called a charitable gift annuity. Some nonprofits, especially if they're bigger, have their own in-house. If they don't, you can use a charitable foundation. And Bluegrass Care Navigators obviously does because they're a great organization. They think about those things. The way a charitable gift annuity might work is this. Let's say I have a client, Miss Susie. She has $200,000 in a CD, right? It draws 3% a year. She uses that $6,000 she gets from the interest to buy Christmas gifts and other things, right? She likes the $6,000, but she'll tell you every day, I don't need that $200,000. The $6,000 is nice, right? It takes care of Christmas. So we propose, how about we look at a charitable gift annuity? And the way this worked is that we take, instead of that $200,000 sitting in the CD, we put it into a charitable gift annuity. It immediately created income to her guaranteed of $12,000. Okay, now she's receiving $12,000. And whatever is left of that amount is going to go to the charity of her choice. In this case, obviously, Bluegrass Care Navigators is going to receive somewhere in the ballpark of $200,000, depending on the overall performance. So, and by using that versus keeping that money in a CD or some other type of fund, she was able to continue to receive income and,
And she got more.
and she got a tax benefit, didn't she?
She did.
She got a tax,
Not for the full 200,000, but she got a tax benefit for
Yeah.
part of that gift. That was the present value of that gift.
So in this case, she doubled her income, she got a tax deduction, and that money gets to go to the charity she intended it to when she passed. Pretty good deal, huh? So charitable gift annuities could be a solution for you if you want to give and receive. A couple other things I want to touch on. Modified endowment contracts. This one is more for the person who's sitting there thinking, I don't want to take away from my kids, right? I love Bobby and Susie, and I want to make sure that they get everything in my state. So let's say that we have a family who has $100,000 sitting in a CD earning today probably about 3.2%. And I say, you know, Mr. and Mrs. Jones, what are we going to use that $100,000 for? Well, I don't know. I guess we'll just leave it to the boys, right? We're not using it. We don't need it. We're going to leave it to them. We want them to have $100,000. Well, I'll say, well, why don't we just give it to them now, right? Why not? Well, it's always, what do they say? Well, what if I need it? Now, what if I do need it? What if I need to go to long-term care or something? So in this situation, a modified endowment contract is a great solution. What a modified endowment contract is actually a modified version of life insurance, actually. It allows us to put that $100,000 into this contract. It immediately creates a benefit to the estate. This is assuming, by the way, the couple's 65 years old, just so you know. Creates a benefit to the estate of about $250,000, 100% tax-free. So now we have $250,000 to give to those two boys. So we propose, why don't we give them each $100,000? And where are we going to give the other $50,000? Bluegrass Care Navigators, right? So, and guess what? Nobody pays taxes on it. Nobody, anywhere. So modified endowment contracts are also great instruments if you have large amounts of cash sitting around that you're not using, especially if it's conservative. Forgot to address one thing. I know one of you guys are thinking, well, what if I need that money, right? I don't want to tie it up in this contract. Well, these types of contracts typically earn between 3 and 5% on your money while you're still living. So 20 years from now, if you need to get that money back for long-term care or some other reason, you probably have closer to $200,000 to $220,000 in cash you can pull from. So the money's still fully accessible. The only bad thing about this strategy is that you're not getting any tax deduction. This is more about you creating a larger estate for your kids and giving a little more to charity. I'm gonna hit one more. I'm gonna touch one more. All right. Charitable remainder trust. Anybody ever heard of that? A CRUT or a CRAT, right? So let's say that we have Mr. and Mrs. Jones owns a $500,000 condo in Florida. We're going to Florida, yep. Yeah, we were going for a farm on this one, but Brittany told me you should use a condo in Florida for some reason. So they own a $500,000 condo in Florida. They realize that their kids don't want this condo. It's become more of a hassle. Nobody goes there. Everybody's busy with the kids and the grandkids. So they know ultimately they would like to see this condo to go to the boys and maybe a little bit to charity as well. So what we might do in this situation is create a charitable remainder trust. And inside this trust, we would move the property, right, the condo in question, into the trust, charitable remainder trust. They immediately get a tax deduction, right? So not quite at the 500,000. There's something called charitable gift appraisal. They'll figure out the numbers, but they'll probably still end up getting 350,000 probably.
Depends on how old they are and how old their beneficiaries are and how long the income lasts.
As you might imagine, the IRS has a lot of rules on this, but you will get a tax deduction up front for putting that property inside the charitable remainder trust. Now, we've sold that property, and when they sold the property.
Charitable trust sold the property.
I'm sorry, the charitable trust sold the property, not us. Now you have $500,000 sitting in there. And guess what? By the way, when you sold that property, guess who didn't have to pay long-term capital gains on that property? The charitable remainder trust. So not only do we get a tax deduction, we also avoided long-term capital gains when the property was sold. So now we have $500,000 sitting in this trust. The nice thing about these charitable remainder trusts, you can pull money back out in your lifetime, right? On average, it's about 5% a year. So 5% of 500,000 is $25,000. So you could pull $25,000 back out of this. Now, one of the strategies we can do a lot of things here, right? Maybe you could use it for income, but we might also use it. We talked about life insurance earlier. The reason we talked about life insurance a little bit, it's a great estate tool to give to the next generation, to give to charity, because you can multiply an asset and it becomes tax-free to everybody in question. So in this situation, Mr. and Mrs. Jones has the $25,000 coming to them. They don't need the money. They never needed it. They just wanted the property and the money to go to the boys one day. So instead, we take the $25,000, put it into some type of life insurance policy that produces a $1 million contract to the family. Okay? So now the boys are going to receive $1 million upon Mr. and Mrs. Jones's death, right? So each son will receive $500,000 apiece. You're tracking with me. But guess what? There's still going to be about $500,000 left in the trust. We're only pulling out 5% a year, and if you have a decent investment advisor, he better be giving you at least 5% or better.
Or she.
Or she, of course, right? Or they, right? We use a lot of pronouns. So now think about that. Your $500,000 condo, you sold. I mean, you gifted, received the tax deduction today. You sold it, paid no capital gains on it. You received income, which you put into a life insurance policy to create $1 million contract. So now, son 1 gets $500,000, son 2 gets $500,000, and the charity gets at least $500,000. Not a bad deal, right? And guess what? You got that big tax deduction and didn't have to pay capital gains on it. So,
Is there a minimum for that charitable remainder trust
No.
that you're talking about?
well,
I mean,
I'm sorry.
like, what's the-
There are different foundations have different rules, and most of them have like parameters on what kind of assets they'll accept. So CRUTs can also be done with appreciated securities. So like, you know, we have some folks that got into NVIDIA, and we're going to beat up on that one because it's had a heck of a year, right? NVIDIA, if you bought it at $34 a share and it's trading at what today?
210.
But it was also split. Anyway, it doesn't matter. But like, there's a lot of people that have a lot of appreciation in there. You could gift that $34,000 of basis that's now worth $700,000.
Mm-hmm.
You could gift that investment, get the tax deduction, or do a CRUT at $700,000, receive income from that. You've skipped capital gains. You're getting tax preferred income over time from that account. Business interests, so closely held business or capitally appreciated business interest. There's all kinds of assets that are acceptable and appropriate for you to consider gifting that most people are not even talking about. So if you have unique assets, certainly speak with a trusted professional. And if you don't have one, we're really good advisors.
Well, I know Laura's biting at the bit to get up here. She wants to say a couple things, but before, to wrap up our portion, again, I want to say this again. Today, we don't expect any of you to walk out of here and be going, I'm going to do exactly that thing, right? Or to be an expert on it or to have a PhD in charitable giving. we could, we could make this a 12-week course, right, and still not get all the information out. Because there's, and a lot of the numbers we used were averages, and everybody's different, right? Not every strategy is right for everybody, but again, we wanted to show you there are so many different strategies for so many different levels of people, whether you make 50,000 or 5 million. All this works, it just multiplies differently. So our encouragement, if you're charitable, right, and you have any assets at all, whether you have $50,000 to your name or 5 million or 20 million, talk to a professional. I will tell you, most financial advisors aren't good at this. This isn't Brittany and I, this is actually a core of what we love to do. We love charitable giving. We love helping people find these strategies. And if you're wondering if your advisor is good at it, has he ever talked to you about it? If he has, if the answer is no, it's probably not a focus of his, right? There might be, or her, sorry. But there might be somebody in the firm, right? Like I said, Fidelity has Fidelity Charitable, so they can bring somebody in. So start the conversation. If you don't have somebody to start the conversation with, obviously we would offer ourselves all day. So we appreciate the time. Laura, I know it's got a few things to talk to us about, so come on up.
Well, let's start with you. I think this has been a really good example of why financial advisors are so important to all of us. I know I've started thinking about retirement more and more, and I still hopefully have a long time to go, but it's an important part of planning and giving back to your community, but also protecting your children and grandchildren. So thank you all for sharing all this. I know they'll be here to answer any questions. So a little thank you. We heard you might like some Kentucky bourbon-y flavored things, so there might be some Kentucky bourbon-y flavored things in there. But thanks for being here tonight. I do want to share one more thing real quickly, because I know we're running out of time, but you probably, if you are on our mailing list, got some information in the mail that looks like this about the Endow Kentucky Tax Credit Program. It is another easy tax-wise way to make a gift and receive some charity or some tax benefits. So if you have a charity that you love in the state of Kentucky, you can give to their endowment fund if they have an endowment fund at a community foundation. So for example, we have an endowment fund at the Bluegrass Community Foundation and at the Foundation for Appalachian Kentucky. You can make a gift of $5 to $50,000. There's no minimum. The cap is $50,000 in a year. And you can get up to 20% of that gift that you've given to charity back as a state tax credit against any state tax liabilities you have. This happens every single year. It's called the Endow Kentucky Tax Credit Program. We have information in the back. I'm happy to answer any questions. It is a very small window. You have to apply between July 1st and July 7th, or you cannot get those tax credits, and that's the same every single year. It is up to 20% because it depends on how many people in the state apply for them. So there is a $2 million pool that the state of Kentucky makes every year, or this year actually they grew it to $2 million, for these tax credits. And what they do is they take all the applications that they get across the state between July 1st and 7th, and they prorate that until that $2 million is gone. So you say you want to give $50,000, and they may come back to you and say, we can't give you 20% of $50,000, but we can say this year we can give you 20% of $40,000, and so that's how much they will give you for that year. So they will tell you, you don't write a check until they tell you how much tax credit they're going to give you back. But this is on top of your federal deduction. So you get your normal federal deduction if you itemize, and then tax credits that you can use this year, and it actually has a carry forward for up to 5 years. So it's a great program if you are giving to a charity anyway, you want to support their endowment, it has to go to their endowment, and get tax credits against your tax liabilities. So love to talk to you about it if you're interested, but the window's coming up very fast.
And if you are over 70 and a half, you can actually use QCDs and still get a Endow Kentucky tax credit on the QCDs that you give to the permanent endowments. Yep. So just for context, a $10,000 tax credit in the state of Kentucky means you have $385,000 of income on the state side that's not taxable. It's a significant benefit.